This is Nightly Business Report with Sue Herrera and Bill Griffith.
Mega merger cleared. Sprint and T-Mobile's $26 billion deal gets the blessing of the Justice Department, and it could usher in a new era for the wireless industry.
Don't bet against the consumer. Spending is powering the economy, which grew at a slightly faster pace than expected in the second quarter.
From the battlefield to the boardroom, how business boot camps are helping female veterans become entrepreneurs. Those stories and more tonight on Nightly Business Report for Friday, July 26th.
And we do bid you a good evening, everybody, and welcome. Well, the S&P and the Nasdaq closed at record highs today. We'll have more on that in a moment, but we begin with that on-again, off-again merger of Sprint and T-Mobile, which now appears to be very much on. After years of intense regulatory scrutiny, the Justice Department today approved the $26 billion deal, which brings together the nation's third and fourth largest wireless providers. That news sent shares of both companies higher today, even though the approval comes with conditions. Ilan Mui reports for us tonight from Washington.
The Department of Justice giving the green light to the $26 billion merger between T-Mobile and Sprint, but forcing the companies to sell some assets as part of this deal. Under the agreement, Sprint will have to sell its prepaid business to Dish and divest Spectrum to Dish. Also, the companies would have to make at least 20,000 cell sites and hundreds of retail stores available to Dish. Dish would also have access to T-Mobile's network for 7 years. Assistant Attorney General Macon Delrahim said that without this remedy, the merger would substantially harm competition. And this settlement sets up Dish as a disruptive force in wireless. This agreement has gotten buy-in from 5 state attorney generals, including Nebraska, Kansas, Ohio, Oklahoma, and South Dakota. Still, the merger is facing pushback from a separate group of state AGs. 13 states and the District of Columbia have filed an ongoing lawsuit to block this merger.
I'm really hoping that this doesn't turn into a political fight, that state attorney generals are able to evaluate this deal on how good this is going to be for their state, how good it's going to be for their constituents.
And it's important to know that the merger cannot be finalized until that case is resolved. Currently, a trial date is scheduled for October 7th, but that could get delayed. For Nightly Business Report, I'm Ilan Mui in Washington.
So how might the Sprint T-Mobile deal reshape the wireless industry? Joining us now to talk about that is Jonathan Chaplin. He is managing partner at New Street Research. Welcome, Jonathan. Nice to have you here.
Thanks for having me.
You say this ushers in and paves the way for, quote, real disruption. How do you see that playing out?
It does. So what the deal does, if it goes through, and bear in mind we've still got a fight with the states here and it's still somewhat in the balance, but if it all goes through and Dish ends up building this network, you'll have 2 networks with a tremendous amount of capacity on them with a very, very low unit cost. And that is a recipe for disruption. So to put that in perspective, between T-Mobile and Dish, they'll have 65% of the industry's capacity. Dish has no revenues in wireless today, except for what they buy from Sprint. T-Mobile and Sprint together, including what they're selling to Dish, have about 30% of the industry's revenues. So they've got the opportunity to effectively double the share they have in the industry because they've got all of this excess capacity and a very low cost. And that spells out disruption in our view.
Right. But the 13 states that still disapprove of this are worried about job loss and higher prices for consumers. Do they have a valid case?
They do to some extent. If what they're worried about is how real Dish is as a new entrant. Dish has been sitting on a pile of capacity, a pile of spectrum for half a decade, and they've done nothing with it. They've made a lot of promises in the context of this deal that should hopefully compel them to finally build a network, put it to use, and get into the business. That's what the fight in the courts is going to be about. It's about how real Dish is, how much can we trust them to follow through on their commitments. But if they do, the things are going to get really, really interesting in the wireless industry. Consumers ought to be big beneficiaries. In fact, any business that has a product or service that's delivered over a network ought to ultimately be a beneficiary of this deal because the costs of connectivity are going to go down.
And what about the cable industry?
Also a beneficiary. So they're in the wireless business today in a very small way, and they're relying on Verizon's network. And the degree to which they can be disruptive is limited by what they pay Verizon for access to that network. And Verizon's got no interest in giving it to them cheaply because Verizon's their biggest competitor. But if they can go and buy capacity from Dish much more cheaply, first of all, they'll have a better, more profitable wireless business. But it gives them the ability to be more aggressive, go after more share, take prices down, all of which is good for consumers.
Well, they cleared a big hurdle today, but there's still those legal issues to face. We'll see what happens. Jonathan Chaplin with New Street Research. Again, thanks for joining us tonight.
Thanks for having me.
As we mentioned, the S&P and the Nasdaq ended the week at records. Investors were encouraged by strong earnings from Alphabet and Intel, which we told you about last night. The Dow Jones Industrial Average added 51 points to 27,192. The Nasdaq was up 91, and the S&P 500 gained 22. The major averages were all higher for the week. Also lifting the market was a report that showed the economy grew at a slower but still solid clip in the second quarter. So where did the strength come from? Well, as with most things related to this economy, it's complicated. Steve Leisman explains.
The government reported Friday that growth slowed in the second quarter by a full percentage point, falling to 2.1% from 3.1% in the first. But the economy did grow slightly more than Wall Street had expected as consumer spending did its best to offset a slowdown on the business side. Rather than focus on that slowing, many economists chose to see the number as a reversion back to a more normal growth rate for the economy. The strength in the first quarter was really the exception. Weak consumer spending in the first quarter gave way to explosive 4.3% spending growth in the second, the best number since the end of 2017. And government spending, depressed by that shutdown in the first quarter, it rebounded to register the biggest quarterly gain since the financial crisis. On the other hand, strong first quarter business spending and inventory growth, well, they turned into negative numbers in the second quarter. Trade also dragged on GDP.
I think it's reasonable to suspect that trade uncertainty is a major factor holding back CapEx. In terms of the forward-looking indicators, maybe we'll do a little better in the third quarter. But that said, the surveys aren't suggesting there's going to be a huge rebound in CapEx anytime in the offing. I think the best thing we can hope for is just some, return to moderate growth there.
So what does growth in the quarter ending in June tell us about how we're growing now?
It's a solid number. Obviously, the inventory piece just creates a little bit of volatility, and the investment numbers are a disappointment, but not a surprise. But overall, we see strong consumers.
Moderate growth would actually be welcome, given that many began 2019 forecasting a recession this year or next. Right now, growth is slowing, but it's not exactly slow. For Nightly Business Report, I'm Steve Leisman.
And that GDP report is one of the last major readings on the economy that the Fed policymakers will see before they meet next week. Now, some say the market has already priced in an interest rate cut, which leaves investors in an unusual position. Mike Santoli explains.
Wall Street typically likes when the Federal Reserve starts cutting interest rates. But what about when a rate cut comes with the economy already in good shape and stocks up 20% in the past 7 months? These are the questions consuming investors ahead of next week's Fed meeting, with second quarter GDP arriving better than expected and the S&P 500 at a fresh all-time high. A quarter percentage point cut in short-term rates has been fully priced into the bond market for most of this month. Corporate bond yields have already rushed toward multi-year lows, giving companies the benefit of lower borrowing costs even before the Fed acts. The S&P 500 is now valued above 17 times forecast earnings for the next 12 months, right about its high valuation for this bull market. Does this mean a rate cut has already front-loaded the full benefit of this anticipated easing of policy from the Fed? Well, there's a risk this is true, but certainly no guarantee. In past cycles, when a rate cut averted a slide into a recession, stocks did tend to perform well after the cut. Corporate profits have come in stronger than feared and are seen beginning to start growing at a healthier pace again late this year, and low inflation and firm credit conditions continue to support equity values. Still, the best rallies of this bull market have come when some widely feared threat did not come to pass, not when a widely expected bit of good news finally arrived. For Nightly Business Report, I'm Mike Santoli.
Well, we're just about halfway through the current earnings reporting season, and we've learned that some, but not all companies are being hurt by the trade war with China. Coke, for example, saw growth in the Asia-Pacific region. LVMH pointed to strong demand, especially in China. And Texas Instruments said it's seeing growth in its 5G products. But Caterpillar noted competitive pressures in China. Align Technologies saw lower shipments to that country, and Las Vegas Sands noted weaker cash flow from Macau.
So after all of this week's earnings reports and this morning's GDP report, it becomes clear that we almost have two economies. Things look good when the consumer's involved, not so good when you talk trade. What's an investor to do with this dual economy? Joining us tonight, we welcome back Liz Ann Sonders, the Chief Investment Strategist at Charles Schwab. Always good to see you, Liz Ann. Thanks for joining us.
Hi, Bill. Nice to see you and Sue, too.
So there are clear haves and have-nots right now.
Yes.
What do you do with that when you're trying to invest in this stock market right now?
So we think this is an environment, given some of the things you already mentioned, this bifurcation where you've got some decent strength in domestic industries on the consumer side of the economy, but weakness in business investment and confidence that business leaders have, is that and given that it's late cycle, you want to kind of snuggle up to benchmarks, so to speak. In other words, don't take undue risk. So what we've been telling investors really for about the last 2 years is keep your equity allocation no higher than whatever your normal long-term strategic allocation is. We have had an emphasis toward large cap stocks at the expense of small cap stocks. Small cap stocks generally have higher debt levels, they have lower profitability. Larger companies have a higher quality stream of earnings, and they can be more nimble around things like the trade war and tariffs. And then at the sector level, we're also relatively neutral. We only have one outperform rating right now and one underperform rating, the outperform being healthcare. So we think it is a trickier time, and that the best stance right now is not to try to make bets in one direction or another.
And does the interest rate environment with the Fed expected to cut next week influence that projection at all, Liz Ann, or not?
I think that an interest rate cut is ostensibly good for asset prices, for risk asset prices. It's been a support under the stock market. What I think, though, is the appropriate question to ask is whether that is going to fix what ails the economy. Mm-hmm. And I'm not sure the answer to that is yes. I don't think what ails the economy on the manufacturing side tied to trade and tariffs is that interest rates are too high. So it begs the question, will a cut in interest rates, a quarter point or even a half point, be enough of a solution to sort of reignite animal spirits, corporate animal spirits, which I think has been the biggest thing that has been damaged. And I'm not sure the answer to that question is yes.
Before we let you go briefly here, I mean, the market has waffled between defensive sectors and cyclical sectors. Right. You seem to be suggesting to sort of take the middle ground here. Is that what I'm hearing?
I think what investors really should focus on is less so on things like sectors, but more so on factors. So I think what's important for investors to look at, especially if they're buying individual names, is stability of earnings, quality of earnings, companies that have rising earnings expectations. So it's that stability quality factor that, quite frankly, you can find across the spectrum of industries and sectors. And I think focusing on those factors is more important than just trying to hone in on a segment of the economy.
Liz Ann Sonders with Charles Schwab. We always appreciate your time. We'll let you get back to the clam bake. Enjoy the weekend.
Thank you. Thank you very much.
A few stories out of Washington tonight. First, President Trump said that his administration would reject Apple's request to exempt its Mac Pro from U.S. tariffs on Chinese imports. Apple has not commented. The president also said he expects Apple to announce that it will build a plant in Texas. Separately, President Trump is threatening retaliatory action against France. The move would be in response to that country's new tax affecting American technology companies. And in a tweet, the president suggested targeting French wine.
Still ahead, not one, not two, but three different types of dividend growth stocks that our market monitor says you may want to add to your portfolio. McDonald's has apparently discovered a recipe for success. The global fast food chain has been modernizing its stores, investing in technology, and raising prices, all of which helped it log its best global sales in 7 years today. That news sent the stock slightly higher in today's session, but it is just a few dollars away from an all-time high. Kate Rogers has more.
The U.S. consumer is strong and McDonald's is reaping the benefits. U.S. same-store sales rose as promotions and store upgrades attracted more diners. CEO Steve Easterbrook said this was the highest U.S. comp since the launch of all-day breakfast in 2015. McDonald's has also been investing in its behind-the-scenes technology to improve and personalize hundreds of drive-thrus. And because of it, people are spending more.
The drive-through makes up about 70% of their sales across the U.S. and they're making investments in the technology there to drive throughput, to drive the average check higher. So in our view, it's just investment behind tech, which is, I think, a smart move on their part.
As delivery competition heats up, McDonald's is doing deals to keep up, recently inking an agreement with DoorDash as a partner while continuing to work with Uber Eats. Globally, delivery is expected to be a $4 billion business this year for McDonald's, and the company has maintained double-digit delivery sales growth in restaurants that offer the service for more than a year. One question remains, will the fast food giant make a move on what appears to be the latest fad, plant-based meat? CEO Steve Easterbrook has said that they are looking at that option closely as restaurants from Burger King to Tim Hortons and Dunkin' all expand their offerings. For Nightly Business Report, I'm Kate Rogers.
Twitter has been experimenting with ways to attract and keep its users. It appears to be paying off. The company reported better than expected earnings and revenue, sending the stock up about 9%. Julia Borston reports tonight from Los Angeles.
Twitter growing its user base faster than expected, adding 5 million daily active users in the quarter. Twitter CFO Ned Siegel saying this growth shows the company's investments in making the platform easier to use and removing spam from it are paying off and showing it has more room to grow.
Our results are a great reminder of how the whole world can benefit from Twitter. And the work for us is to help people find what they're looking for quickly, to remind them about the events and topics that they care about most, whether it's a sporting event in the United States or a political event in Asia. These are things that people all over the world should care about. And we just have to do a better job surfacing the things that people are looking for.
Twitter CEO Jack Dorsey says that now they have a better understanding of what Twitter is and why people use it, enabling them to prioritize what they should be working on. And now that includes improving the platform by making it easier to follow and participate in conversations.
This company is starting to really generate a track record of consistency. Investors like that. Whether they're going to have to materially increase infrastructure investments around trust and platform security, that's the question mark for me and for some investors.
Siegel and Dorsey both stressing the company's focus on becoming more nimble so it can quickly implement changes to keep its users hooked and work to prevent manipulation on the platform. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Higher prices give Colgate Palmolive a lift. That's where we begin tonight's market focus with the consumer products giant reporting weaker than expected earnings, but they did see an increase in organic sales. The company raised prices for its products to offset higher raw material costs. Shares rose more than 2% today to $73.69. Goodyear missed estimates due to slumping sales, falling global auto production, and higher raw material costs. The CEO says that the tire company does continue to struggle in what he called a challenging environment. And the stock fell more than 5% today to $14.16.
Pharmaceutical company AbbVie topped estimates thanks to a sales increase in its cancer drug, Imbruvica, but the sales of its blockbuster arthritis drug, Humira, fell. AbbVie also raised its full-year forecast. Shares are basically up more than 1.5% to finish at $67.76. Phillips 66 reported mixed results as it posted better than expected earnings, but it fell short in revenue. The energy company had higher oil refining margins and more volume in its pipelines and its natural gas liquid terminals. The stock was up a fraction to $102.32. And Illinois Toolworks also reported mixed results with an earnings beat, but it missed on revenue. The equipment manufacturer also lowered its full-year guidance due to soft demand. Shares fell about 2% to $155.63.
Time for our weekly market monitor, who has 3 different types of dividend-paying growth stocks that he feels should protect your portfolio should equities sell off. Last time he was with us, by the way, last October, he recommended these 3 companies: O'Reilly Automotive, which is up 14% since then, IDEX Laboratories, which is up 27%, and MasterCard, which is 39% higher. Back with us tonight, Doug Butler. He's portfolio manager at Rockland Trust. Doug, good to see you again. Thanks for joining us tonight.
Great. Thank you for having me.
So we're talking dividend stocks, but we're starting with 3M, which today became something of a controversial company because they revealed an internal investigation into potential violations of U.S. foreign corrupt trade practices. Here's their statement that they issued to explain what this investigation is all about. They said through this internal process, they discovered certain travel activities and related funding and record-keeping issues, raising concerns arising from marketing efforts by certain business groups based in China. We just felt the need to disclose all of that. You still like the company, or does this give you pause at this point?
I think anytime you're seeing one of these foreign corrupt trading, which largely tends to be bribes paid normally by people who are not necessarily super high up, it always gives you a bit of a pause. But I think 3M in particular is a company that has weathered so many storms. They've paid dividends for 100 years. They've grown their dividends for 60 years straight. They're a global player, and there's always going to be some headline risk around names that do a lot of business in China or in parts of the world where the corrupt services may come into play. But I think we are still confident in the long-term prospects and the prospects of 3M. Again, it's damaging if it ends up being meaningful, but we're comfortable with the name.
Very good.
Let's go to your other pick, Cerner, the leading company in digital health records.
Yeah, I mean, I think everybody knows when you go to the doctor now, you see an iPad in their hands normally, and you see it at every hospital. Almost every hospital in America now has electronic health records, or every major acute hospital. And frankly, 87% of physicians' offices now use electronic health records. So it's really becoming very prevalent. And we like them because they're the sort of stock that's a dividend initiator. They just decided to pay a dividend for the first time. And again, this is sort of getting in on the bottom floor of the massive dividends we project a client earning for years to come.
Quickly, if we can, on Fastenal, the industrial supply company, they have a dividend yield of 2.7%. Suffered a little bit the last couple of months. What do you like about them?
Well, I think they suffered. The news came out in terms of the GDP numbers this past quarter, and business confidence suffered this time. And we think business confidence will recover. We still believe that the trade war will not be, a full-scale, full-blown, no-holds-barred trade war. We still think there's room for negotiation, and we just think it'll take a little while. It's going to probably take another 6 months. But we still see them as a company that has many growth opportunities ahead of it, and especially in building they're a different type of connectivity than we're used to talking about.
Doug Butler with Rockland Trust. Again, thanks for joining us tonight.
Thank you.
Coming up, closing the gap for female veterans.
From boots on the ground to boot camp for entrepreneurs, how military veterans are transitioning to the civilian business world. I'm Contessa Brewer. I'll have that story coming up on Nightly Business Report.
The gender pay gap among veterans is wider than in the general population, and that's where a program out of Syracuse University comes in. Contessa Brewer has the latest installment of our Closing the Gap series.
Natasha Nori Standard spent 20 years in the Army.
I had opportunities to be a commander. I was airborne. I worked in special operations. I supported special operations around the world.
When she retired, with all her skills in logistics and management, she took a job at Williams-Sonoma. There were some hurdles.
It was the lack of camaraderie, lack of values. So, civilian values are different than military values.
After 7 months, she quit. Though she landed an interview at Amazon, Nori Standard opted to start her own business, shoes.
I remembered how much I loved shoes from being stationed in Italy.
To get her shoe business off the ground, she needed a boot camp, one designed especially for entrepreneurs and especially for veterans. She found it here at Syracuse University. With an Institute for Veterans and Military Families, Syracuse is tackling the challenge of transitioning from the armed forces to civilian life. But for women, that can be especially challenging.
Getting their transition right is core to ensuring long-term employability and financial independence.
Maureen Casey testified before Congress about the problem. Women vets spend longer looking for work, make 30% on average less than their male counterparts, and may struggle in a corporate environment.
We have seen an uptick in the number of women that are drawn to entrepreneurship programs, running counter to the trend where we've seen a decrease in veterans going into entrepreneurship.
With lessons on business strategy, marketing, pitching to venture capitalists, the boot camp has been so successful, it's been duplicated at 8 other universities, graduating 2,000. Another program aimed specifically at helping women vets with small business skills has seen 3,000 graduates, 65% of whom started their own business. 90% of those are still operating. For Derica Davis, the coaching is invaluable in growing her health and wellness business.
These programs and the experience that you get in the military prepares you to be up for the challenges, and no matter what, you can keep persevering.
Starbucks former CEO Howard Schultz gave $7.5 million to help fund this effort, and corporate partners include JP Morgan Chase, PepsiCo, Walmart, Lockheed Martin, Prudential. The private sector stepping up to help veterans put their best feet forward. In Syracuse, Contessa Brewer, Nightly Business Report.
And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. We finished the week with a record for the Dow, for the S&P and the Nasdaq, and we have a Fed meeting next week as well. Should be interesting. Have a great weekend. See you Monday.